Hi, I'm Shelley Kraft. Welcome to our Planet MicroCap showcase. In particular, tonight we have on stage what I call the accounting panel. But let me tell you, it's a lot longer of a title, and I'm going to let Neil Levine, who is going to be the moderator of the panel, take it from here. Ladies and gentlemen, the accounting panel.
Thank you, Shelley. Hello, everyone, and welcome to the Planet Micro Showcase, the accounting panel, new Nasdaq rules and trends affecting issuers in 2025. I'm Neil Levine, a managing director at CBIZ, serving capital markets since 1998. I'm honored to be the moderator of this panel. Since the inception of the conference almost 11 years ago and a major sponsor of this event. I serve mainly as a relationship partner and business developer at CBIZ. We currently are the 5th largest firm in the country with over 500 public clients and are fortunate to be involved in most aspects of companies that go public. I'm delighted to have the following panelists answering our questions today. I've known each of these experts for many years. We've all served this panel over the years. So we have Corey Fischer, managing partner of Weinberg and Company, a PCAOB firm. We have Neil Reithinger, president of Eventus Group, a CFO services and consulting firm. Stephen Kreit, managing partner of Kreit and Chiu, a PCAOB registered firm, and Kelly Anderson, who's here with me for the first time, the CEO and founder of Executive Solutions, LLC. So with that, I'm going to turn it over to my panelists to introduce themselves and to tell us what services they provide. Corey.
Oh, thank you, Neil. It's great to be back here again. My name is Corey Fischer. I'm with Weinberg and Company. We are a firm that specializes in auditing the small cap public companies. We've been doing it since 1991. We're based in Los Angeles with offices in Florida and then in Asia as well. I personally, I'm managing partner. I have previously worked with Deloitte, and before that I was CFO for a couple of different publicly traded companies. Kelly?
Awesome. Thanks, Corey. I'm pleased to be here for the first time on the panel. I'm Kelly Anderson. I am the CEO of CXO Executive Solutions, a firm that provides executives and board members to companies on an interim basis as well as a permanent search basis. I'm a retired public company CFO. I was with various public companies on the microcap as well as mid-cap and large cap. And for the past 10 years, I have sat on various public microcap companies as audit committee chair.
Thank you, Kelly. My name is Steve Kreit. I am the managing partner of Kreit and Chiu CPA. We're a public accounting firm. We specialize in audits, in PCAOB audits of companies that are either going public or already public. One of the things that differentiates us from other firms, half our clients are international companies that are going public here in the U.S. We're 100% remote, so our people are basically where our clients are, half here in the U.S. and half spread out all over the world serving our clients.
Thanks, Steve. Neil Reithinger, managing partner of Eventus Advisory Group. Like Neil mentioned, we're a CFO advisory firm, which means everything in the office of the CFO, no assurance like these two gentlemen. And we are specialized in all public and private companies. So whether it be accounting, controllership, strategic CFO work, technical accounting, pre-audit prep, pre-IPO prep. We have a staff of 60 people across the country as well as in the Middle East, Asia, and Canada. So we'll help Canadian issuers, U.S. issuers, OTC, exchange-listed issuers. So our team has been with large and small accounting firms, the PCAOB, the SEC, the bulge bracket investment banks, so broad experience, been around for about 17 years, so happy to be here. Thank you.
Thanks, guys. So let's start off with Corey. Corey, as companies struggle to meet or obtain the proper Nasdaq equity requirements, what changes in common financing vehicles or terms resulted in significant unanticipated accounting impacts?
Thanks, Neil. This year, Nasdaq, as most of you know, instituted a number of changes, including raising the equity limits to continue listing or even get initial listing on Nasdaq. And companies raise equity, they traditionally do it either through the sale of common stock with a unit that would include a warrant, or perhaps preferred stock. And in all these instruments, other than in just a typical sale of a common stock, share of common stock, they've had to sell the deal, they've had to introduce different types of investment inducements. And certainly, in the market, to do these deals, they had to do that. So each of these, when you look at the types of instruments that are now out there, whether it's a warrant or in a preferred stock, have new terms in them that are causing a lot of these instruments to not be equity, or to create liabilities, unanticipated liabilities that cause companies not to meet these equity requirements, even though they're raising the capital that they thought was going to create the equity. For instance, in the warrants, the warrants, you have to be very careful because there's a number of terms in these warrants that will create liability treatment. Number one thing would be if there's any sort of term in there that creates a net cash settlement, if the warrant permits or requires cash or any sort of settlement under any condition, where there could be variable settlement provisions that require or that may result in a variable number of shares to be issued. If there are adjustments based on inputs, like if there's a VWAP, that the price resets to a VWAP. If there are not sufficient or authorized shares to issue these warrants. These are all types of things that you think you're going into a deal, and they actually could prevent the recording of equity. So the whole, if companies need the cash, that's fine, but the equity is not going to end up getting recorded. In addition, this year we saw a lot of changes in, or new types of instruments, including what's now people call an exploding warrant, where it may result in the additional issuance if the terms of the warrant possibly will reset based upon a future down round protection or something, and the number of shares to be issued could also increase. So what happens is the company is going to issue significantly more shares than anticipated. And so for instance, you may have 500,000 shares outstanding when you do these types of deals, but because this warrant, let's say you go out at $2 a share and the exercise price of the warrant is $2 a share, but it's based upon the exercise price is based upon a VWAP, volume weighted average price after the offering. A lot of these offerings go out $2, $3 a share, but as soon as they hit the market price drops to 30 cents. So all of a sudden now that warrant goes to 30 cents. And the number of warrants you issue goes up. So you're going to have to issue a significantly large amount of warrants, just to usually on a cashless basis. So not only is it doesn't go to equity, number one. Number two is you've killed your dilution. So the other instrument that we've seen changes is in the preferred stock instruments. Preferred stock, by definition, upon liquidation, you get preferential treatment to the common shareholders if there's a bankruptcy or a dissolution. But now what the underwriters have done is they've stuck in things such as deemed liquidation events, things that could occur, and they will force the recording of that instrument not to be equity, but something called temporary equity. It's not a liability, but it's not equity, but it doesn't go into your NASDAQ calculation. And we've seen a lot of these because the underwriters need to put in these terms just to sell the deal. So, those things have been very troublesome this busy season.
Yeah, thanks, Corey. Neil, having worked with public companies now for several decades and having experienced several economic cycles, what guidance are you giving clients or prospective clients on how to navigate these current financial markets?
Sure. Well, you know, we did see some, obviously, green shoots of hope maybe late last year, earlier this year, which definitely dissipated. It's a very tough environment. So I think what's important is that that companies have a focus of a sort of at the ready. They have to be at the ready for a window of opportunity, right? You don't know when that investor is going to pop up an opportunity with your investment bank, or just simply a window in the capital markets that may occur, such as the Nasdaq company that all of a sudden has some crazy day where some algorithms kick in and you have hopefully a shelf registration out there and you can raise some capital. But you just have to be at the ready with this, even though, you know, it's not necessarily just Nasdaq companies, but also companies on the OTC as well. So you can't control valuation, right? You have to be discerning about structure. You can always say no. Some of these structures, like Corey was saying, I mean, they're very toxic. So obviously, being in a position to be able to say no to some of these, or to at least have optionality out there, and then of course you have to have financial processes and controls in place so that you are always current and compliant, what have you. So, you know, but more fundamentally, you know, your business, is it executing, right? You know, are you off plan? Are you on plan? Why? You know, is your business have a defensible position even if you are profitable? You know, what are your expectations on valuation? You know, so that can be managed. You know, what's the cap table look like? Who's on it? You know, what potential is lurking there, and so on. You know, can the company withstand more, you know, appropriately for private companies who aren't publicly listed, due diligence? You know, do they have a data room ready? Do they know that they can respond quickly if something comes up, whether it be, you know, equity or any debt-related instrument, right, so that they can raise money? And, you know, your financial controls in place so that you have that developed and your team is ready to do that. So whether that's part of an IPO, whether that's part of a continued, you know, capital raise or follow-on offerings. But there's also, it's interesting, there's also this concept of a confidential filing that you put out there that, you know, obviously the holy grail is an S3 and you can draw on your shelf offering, and that's the best thing in the world, right? And there's this concept of the DRS, put it out there on file to have it ready, right? And there's actually some rules around that have expanded, and it's just even March of this year where, you know, if you're a first-time IPO, you can't have that in the first year, or if you somehow blow your S3 eligibility, you're late on a filing, which is obviously, you know, for a Nasdaq company, you don't have that shelf availability. You can now file that DRS, and you can actually have that updated. The SEC is not going to do any final review on that until, you know, it goes live, but that's actually has merit, that option. So I think, you know, it's not applicable for OTC companies unless you're about to uplist, or if you're not going to do an immediate raise. It's more on the exchange-listed companies, but I think that's a viable tool. So, you know, talk to your counsel about that. I think those are options just to be, you know, ready at sort of, you know, and to dive into that window when it occurs.
Thanks, Neil. Steve, what are your thoughts of the current regulatory environment, and where do you see it heading in the near future?
Thanks, Neil. So you know, the way I would say it is it seems to be, the current regulatory environment seems to be easing. You know, throughout my career, I kind of look at this as a pendulum, swinging from one extreme to the other, depending on the administration and other things that are going on in the world. And for the last number of years, the regulatory environment has been very difficult. You know, high regulation, a lot of both the SEC and the PCAOB really going after companies and auditors and different things like that. So really, there's been a lot of change recently. You know, you really can't talk about regulation without talking about enforcement. So one of the biggest things actually that happened that affected this past year was a Supreme Court decision back in June, and essentially that you can't use administrative judges anymore. You know, when you're in order to you know, for fines and things like that. I'm sorry, I lost the word for a second. You can't bring that to regulatory judges anymore when it comes to fines and other things against companies. And if you look at what happened both before and after that ruling, there was some significant changes. It's like the tale of two cities. So the PCAOB, for the third year in a row, actually increased activity. So there were more, you know, more investigations. There were more fines. I think the third year in a row with record fines that the PCAOB gave. But if you dig into the stats a little bit, you know, they publicly disclosed 51 different actions during the course of 2024, but only 10 of those came after the June decision. As far as penalties go, if you look at the penalties and you look at the calendar, only 2% of the penalties that were obtained in 2024 came after that June ruling. And if you go back to 23, about 80+% of the penalties came in the last 6 months of 2023. So you could really see the effect that this ruling had on those items. For the SEC, after that ruling came out, really most of the actions that they had going on were dropped. And even if you look at the cases, they only brought 7 new cases during the year, which is a little less than half of what they had brought back in 2023. The other piece, when you're talking about regulation, you have to talk about the SEC. Paul Atkins was confirmed yesterday as the new chair of the SEC. And even before that, there was a lot of deregulation going on since the new administration took over, even before Mr. Atkins took over as chair. They stopped policing the crypto market. They had about 10 cases against crypto companies that were going on. All of those were dropped. But they did launch a task force to come up with clearer, better rules around the crypto industry. They stopped pushing and stopped defending lawsuits around the climate changes, and they made it easier for companies to block votes on shareholder proposals. So, and that was just from January 20th till yesterday. Paul Atkins is a former SEC commissioner. He was very vocal when he was part of the SEC. I think, if I'm not mistaken, George Bush put him on to the SEC. But he's always talked about, protecting investors and things along those lines. So while I think there'll be some shifting in some of the regulations coming out of the SEC, I don't believe that it's going to turn into the Wild West anytime soon. He's talked about a lot of different things. He talks about applying a cost-benefit analysis when the SEC is going to put out new regulations. So, like I said, I would really not be expecting a big change from the SEC, overall. But there could definitely be some more focused areas where they're going to both decrease and increase regulation. As far as the PCAOB, when the PCAOB started, I started going through inspections. It really seemed that their mission was to try to improve audit quality. I know they still say that, but it really felt it then, that they would work with the auditors and they would come in and do inspections and make recommendations and really help the audit firms improve what they were doing. They've moved to really more of a regulating through enforcement over the last couple of years, and I do see that changing going forward. And I'm cautiously optimistic they'll go back to the way they were in really just working to improve the things we do every day.
Yeah, I would just like to add, 10 or 15 years ago when I went through the inspection and we got a clean report, we would be able to sell that to investment banks, to clients, to, other providers like Neil. But in these days, to obtain that clean report is almost impossible. It's causing so many more costs for the auditors to worry, the PCAOB's coming in, and am I going to get caught up in some enforcement? It's just, we do hope that the regulations are relieved a little bit. Wow. Kelly, as a MicroCap Audit Committee Chair for various companies, how are you anticipating the Nasdaq rules for listing, and what approach or approaches have you seen to address these new rules, and what do you see as the future in MicroCap listings?
Awesome. Thank you, Neil. Yeah, it's a precarious time for microcap companies. Nasdaq's getting very aggressive on their minimum listing rules. You have to have the $15 million to uplist on there. You're seeing a lot of deal structures that are getting pushed back. I'm seeing a lot of pricing when it comes down to pricing committees, that companies are backing off of pricing and just killing the deals or delaying them if they don't come in. A lot of what we're doing from audit committee is we're now pro formaing deals more than we ever did. It used to be, MicroCap needs cash. Almost all MicroCap companies need cash to get to the next level. And some of them are stuck with the deals that are at hand versus trying to get the best deal. And now it's more of let's do the pro formas and see where we're at and see where it's going to end up putting the company, and is it worth the risk, or do we cut back on things and slow down some of the progress we're trying to make. I think it's just been very, very interesting discussions that, it used to be, where are we going to get the cash, what are we going to do with it? Now it's really, what is it going to look like, and is it going to put us at risk for some of the listing requirements? I think that I've had quite a few discussions with Nasdaq. I do sit on a biotech company, and as we know, a lot of biotech companies are probably not going to have revenue for a really long time, and they have to continue to raise cash. And that's really what Nasdaq was built on, right? They were built on biotech and technology companies, and they said that they are really re-looking at that to understand what the effect is going to have, but we can't count on that as audit committee chairs. We have to really look at what we have. I think from the audit perspectives, we have seen auditors being much harder on testing, on documentation, on questioning, on the number of selections they have, and if stuff isn't exactly to par, to continue to dive into that. And a lot of it is the PCAOB requirements coming down, and some of the auditors that have had some of my companies picked for audit, and just the nitpickiness of some of the things that you just go, wow, I just can't even believe that they commented on that and stuff. And one of them was the file had to be completely closed before they issued their audit report. And as you guys know, a lot of you auditors, sometimes you clean it up afterwards. They got dinged on that, and so that makes it really hard on the quarters, especially with microcap companies that are not necessarily fully staffed, as Neil can attest to, and the quarters can be difficult now to have all that stuff buttoned up, and it just moved forward the deadlines and made them very tight to get your Qs and Ks done. And then same thing as comp too, looking at comp and how comp runs through your equity section. And do you start taking, especially executives that own quite a bit of the company, instead of doing, options, do you start giving stock, because it's kind of a net zero number going through on your equity? So we're having a lot more of those conversations on making sure that we're not continuing to drive down the shareholder equity, especially in companies that, like I said, are probably not going to be profitable for a long time because they're more of a technology or a biotech build.
Thank you, Kelly. Corey, other than some of the analysis of financing transactions that you spoke about, we just finished a heavy 10K season. What other accounting issues did you see come up during your audits through December 31st?
I think the biggest issue for many companies, especially as they're looking at the challenge of maintaining the tangible, the net worth requirements for NASDAQ, is in the valuation of the acquired assets and perhaps goodwill, because lots of times for the biggest assets on the balance sheet, especially if a company has gone through an acquisition in the last year or two, usually the small cap companies give large blocks of shares. The shares get valued at the market price at the date of the transaction, and that may be, that's the accounting, may be a little different value than if somebody paid cash. So you usually have these very high valuations on a lot of our, in the small cap world. And companies are required to do goodwill impairment tests, and these are very subjective. They involve lots of estimates, a lot of management judgment, and quite frankly, for the auditors, it's probably going into a PCAOB inspection the most difficult area to defend, because it is all based upon future projections. It's based upon a lot of different analysis. So I think a lot of these companies this year probably found themselves fighting with the auditors about some of these impairment issues, because a write-down could wipe out a lot of the equity. So I think that was probably, one of the biggest issues that I saw this year, especially as it related to the continuation, the equity requirement.
Thanks, Corey. So Neil, aside from a sound financial operations process for monthly reporting that every company should have, what are some of the other best practices that you believe issuers should implement for SEC filings?
Sure. Obviously, we expect smaller companies to not have as deeper resources and staff, and everybody knows that, right? So, but I think that what has to happen is proactive steps to build around that, right? So, you've got, and you got to know what you don't know. When do you need to get help, and so on. So you need to, as Corey was mentioning, when you talk about valuation issues, what are those issues so you can get ahead of those? They're not coming up at the last minute. Whether they're brought up by the auditor, they shouldn't be brought up by the auditor. The company should know that ahead of time in their planning and what they're doing as far as them planning for things, the deficiencies and, their financial close. I mean, it's just table stakes. You got to have a good financial close and operational processes. You're never going to do any reporting, right? So you got to build best practices around that. What that means, if you need help, that's fine. Building and putting together SEC compliant financial statements. These are all technical skills and things that companies need to have, and larger companies have staff in-house to do that, right? And then there's key executive departures or departures of key individuals, loss of institutional knowledge, and so on. So just to be mindful, the management, can rely on external parties to do that, but they really need to be proactive and do a lot of this themselves with really participating, whether it's even writing a business description or so on, or actively, putting together a full filing. That definitely the resources out there, but management needs to have and be proactive with these steps to stay ahead of this and make sure they have the right either internal staff around them or external steps. So all these are proactive things that management could be doing. And there's other things like non-financial disclosures and driving the process, the ownership of whether it be a filing, the document, what have you. I mean, we have many instances where, we'll make sure we can do that for a client, but they really need to be involved themselves to make sure they're a part of that process. Planning and putting Gants together and charts, make sure everybody meets their deliverables. The auditor knows what they have to do, but you got to make sure you have what you're going to do, maybe a weekly meeting, bi-weekly meetings to make sure you stay on top of things to get it done. Make sure you file on time. And then, and I think what's important too is postmortems too with your team. What you're doing, what went right, what went wrong. How do we not replicate bad behavior, and we course correct where things didn't go right. We continue to lean into things we did correctly to make sure that we want to do that to be successful. So I don't think it's just a matter of we got the filing done and that's great. You have to really be active as management as well. Like I said, knowing what you need to do to get the proper support to do that. Okay.
Yeah. So Neil, to jump on top of that, how does a company just get educated? So we have CEOs, we got guys that own these companies, and this is piggybacking. They'll come in, they'll go, hurry up, Levine, we need this audit done. How do they know that they have to see a guy like you to set up the processes, to have financial state? Like, a lot of these guys are just not educated with great ideas. How can we educate them?
Well, I mean, some companies may not know it's out there, that resource. They look at your lawyer, your auditor, your investment bank, your transfer agent. A lot of times the role of that advisory role isn't as clear cut, but it's definitely one that those who are at the epicenter of the world we live in know it. And of course, if you're lucky enough to have referrals from someone like Neil, which we never get, you have to educate them yourself. But it's all about us as all constituents in this community knowing each other and knowing where clients could seek help. And it has to be done unselfishly. You can't say, well, I have an auditor. Who do I want? What's the best fit for the client? What's the best firm to help them with anything, for that matter? Whether it be an advisory role on deal making, whether it be what we do, whether it be the appropriate fit for a SEC counsel, whatever that means. But you got to put yourself out there and know. So these companies have that, but a lot of them may not know that unless they come to a conference like this and they can actually meet everybody else and hopefully get the right advice.
Thanks, Neil.
Well, I can piggyback onto that,
Yes.
kind of jumping ahead onto my side of it. Same thing as audit committee chairs is knowing people like Neil when you either have a turnover at the CFO level or the accounting, or you start having issues with the audit. A lot of times it's you have a complicated transaction. You're definitely 90% of microcap CFOs can't handle complicated transactions. And I shouldn't say can't handle, they just don't have the experience around it. So as audit committee chair, we're constantly talking to firms like him, and also constantly talking within the company about when do we bring on resources, when do we help, when do we bring on somebody like Neil, even if it's to run maybe an internal audit function, because you've had some issues on the audit, you've had some issues getting some things done, you've had some issues with understanding valuations and estimates, and even just the documentation of paperwork. We're constantly going back and forth on that at the audit committee level, and especially if you have a changeover at the CFO, it makes it probably gets exasperated even more. And hopefully your change was a better person that was in there, but sometimes it's not, and sometimes you've regressed back. So knowing people like Neil is really, really important.
I'm going to just add one thing to this as well. Just if you're an issuer and your auditors tell you you need someone like Neil, go find someone like Neil.
Yeah.
It'll save time, it'll save aggravation, and even with the extra service provider, it'll probably save money.
Thank you. Steve, rumors that the PCAOB is going to fold into the SEC. So what is that going to mean for accounting firms' inspections? What is that going to mean for costs? What are your thoughts on this?
So, well, for starters, the short answer is I'm not sure it's going to happen. But, there is certainly rumors going around there, and those rumors are founded. I mean, Paul Atkins, when he was a commissioner with the SEC, spoke a lot about folding the PCAOB into the SEC. But as they said in The Princess Bride, I don't think that means what you think it means. So, at the end of the day, there wasn't any discussion about getting rid of the responsibilities and the roles that the PCAOB has, just moving them to, basically a different department. I think if it happens, I think that, as I said in my earlier answer is about, I think regulation is easing in general. I think moving the PCAOB into the SEC would continue that trend, but firms are still going to be inspected. We're still going to be regulated. We're still going to be inspected. They're just going to be doing it basically from a different location or from a different chairperson in charge.
Okay, thanks, Steve. Kelly, what are the challenges microcap companies face to attract, retain an accounting team who has the experience needed to run a microcap company?
This is probably the biggest challenge that I face as audit committee chair, is really finding the qualified people and keeping them. A lot of it has to do with capitalization. People love to work for very well capitalized companies, and ultimately when you run into an issue, you may lose somebody that's really strong. It's really important that we stay close as audit committee to between the auditors and the CFO to understand the transactions that are happening. Making sure they have the incentives. When you see your stock price get hit by 20, 30, 40, 50, 60%, and all of a sudden that equity isn't worth anything, you start seeing turnover, especially in the CFO position. And then I think the culture. I think one of the hardest parts about it is to truly bridge that gap between the CEO who just wants to go, and, hey, don't worry about that stuff. Accounting is just what it is. I need you to work on some other things, or the results at all costs. We're constantly battling that too, is the results at all cost of, hey, we should just be able to record all this revenue. It sounds good. We should be able to put it in here. So it's really working through that, and it's finding that fine line between setting the right boundaries, and then if stuff gets crossed, and you bring people in like Neil to help shore some of that up. But it is a constant battle, and one that we have to, as audit committee chair, have to stay close to our CFO, and not just at the end of the quarter. It's talking to them on a regular basis on what transactions are they, where are we at, and especially if we're running out of cash, is really staying on top of the cash.
Yeah, so Kelly, to piggyback on that, with the shortage of accountants coming out of school, with the accountants who don't want to get their CPA and do it to 5 years, how are you finding just getting people? Because I know we are on all college campuses. I'm on the board at Stockton University. I'm trying to talk to 180 students to stay in the profession and tell them how great it is. but what is a private company? What are you feeling with the shortage?
So from my perspective, it hasn't hit us as much as it has hit people like you, because again, from a CFO perspective, they've come up through. You still have a bunch of them. I'm the same way. I sit on the accounting advisory board for Cal State Fullerton for exactly the same reason, right? We need to get more accounting students in there. We need to get more CPAs. I think the good part is that if you can bring in a lot of technology, one of the brightest parts about some of these accounting students are they really can assess and understand data very well. Getting them to the CPA side of it, there is a lot of discussions, as you know, at for the CPA license to take it back to a 4-year degree, especially in light of the fact that college is so blessed expensive, and that's really the inhibiting factor. I think if they would go back to a 4-year degree, I think you'd see an influx of CPAs coming back on. But until they do that, it's really, I mean, it's people like us getting out there and talking to the kids about how important it is and what it can be. I think for the first time, and you've probably seen this too, but when I first started working on the advisory board, and especially through COVID, you were talking to these kids about, well, what do you want to be? Everybody in college wanted to be an influencer. That's all they cared about, right? I mean, I'm going to be an influencer. It's so cheap, it's so easy, and I can make all this money. I can sit at home. I'm not hearing that anymore, so that's really good. So I think that we have an opportunity to kind of steer. And, you know, all of you guys should play that part too, between your kids, your grandkids, your friends' kids, is really talk to them about what a great career it can be.
Yeah, so Neil, with that being said, are we competing, or the public accounting firms competing with the CFO advisory services firm for these same kids? I mean, how are you feeling it out there?
I don't think so. I think that the ability for the larger firms to be able to incubate good talent is a resource we don't have at CFO advisory firms, even large competitors. I mean, you can bring in kids from college and recruit them, train them, give them a career path with a Big Four, for example, and other smaller firms, and you can afford to develop these careers, right? Smaller firms can't do that. Companies can't do that. When we have to hire somebody, they have to come and literally hit the ground running. So I don't think so. I think, as we say, we have recovering auditors on our staff. So they don't want to be auditors anymore. It's just one of those cycles in their profession where they're on the technical side, at least. The same thing could go for controllers wanting to be on the consulting side. There's a spectrum of, just like lawyers, you have the securities lawyers and, you know, real estate lawyers and tax lawyers. Just like not all CPAs are created alike either. So there's a different career path for all of them. But we well, certainly as our firm size, but even some of the larger CFO advisory firms that are out there that are excellent, they just don't have a deep enough bench to be able to do that training like the large firms. So I don't think so.
Okay, thanks, Neil. Good perspective. Thank you very much for attending, and we'll see you again next year.